Good morning. I am Jessica Spreitzer with the U.S. Meat Export Federation, and I am speaking to you today from USMEF headquarters in Denver, Colorado. At USMEF, we are here to support you as best as possible during this difficult time. So even though I wish I could be with you in person, I am happy to have the opportunity to discuss the U.S. situation with you today virtually. In this presentation, I am going to provide an overview of the beef and pork markets in the U.S. And to do this, I want to start by going through some of the shifts we have seen since the onset of COVID-19 in the U.S. So instead of starting with a presentation agenda, I want to talk you through this timeline. For the first quarter of this year, both U.S. beef and pork production were record large, and exports were also on a record pace. The U.S. was benefiting from new agreements with Japan and China, and through its ability to provide high-quality red meat at a time when other suppliers and importers had tighter beef and pork supplies. In the U.S., we really did not see any effect from COVID-19 on a day-to-day basis until mid-March. Mid-March is when panic buying started setting in, and I took the picture below on March 13th at my local grocery store, showing the completely sold-out meat case. California was the first state to issue a stay-at-home order on March 19th, and most states in the U.S. followed suit, issuing stay-at-home orders in late March and at the beginning of April. With the stay-at-home orders, we saw a rapid drop in food service demand. Suddenly, only takeout and delivery were permitted, so this hit full-service restaurants especially. But quick-service restaurants also saw a sharp decrease in breakfast business, with consumers no longer picking up breakfast on their drive to work. And restaurants in central business districts that depended on lunch business were also severely affected. So, because of this decrease in food service demand, we initially saw a decrease in prices for most wholesale pork and beef cuts at the beginning of April. Retail demand remained strong in April as consumers needed to make more food at home throughout the month and as children were home from school. But in April, slaughter levels started to slow as COVID-19 led to plants operating at lower capacities. In turn, wholesale prices began to surge in the second half of April as the lower weekly production and slaughter levels more than offset the drop in food service demand. On April 28th, President Trump signed an executive order to ensure that meat plants would continue to operate to the greatest extent possible, while following CDC and OSHA guidelines. In May, prices continued to surge as retailers and food service operators, like providers of fast food hamburgers, needed to secure supplies. After significant investments by the plants, slaughter levels started to recover, and last week, slaughter was the highest since the first week of April for both cattle and hogs. Subsequently, prices began to ease last week for most beef and pork items. States are slowly starting to lift restrictions, and many restaurants are beginning to plan for a slow reopening, with restaurants in some cities already allowed to open for dine-in service. Here in Denver, the city is planning to temporarily allow the closure of some streets so that restaurants can provide dining to customers seated at outdoor tables. So keeping that in mind as the larger backdrop for the U.S. red meat situation, let's get into some of the specifics for beef and pork. According to data from the U.S. Census Bureau, panic buying and stocking up in March led to grocery sales being up 29% from February and up 31% from March 2019. April grocery sales eased from March, but were still up significantly year over year. Retail demand remains strong as consumers needed to prepare more meals at home for their families, including lunches for their children now that schools were closed. Meat items saw strong demand as consumers stocked up on convenient items like ground beef, beef roasts, hot dogs, and pork chops. Supply chain disruptions occurred as suppliers tried to shift supplies from food service to retail channels on the surge in retail demand. Because of the different packaging and specs for food service products, like for bacon, it was often not possible to immediately shift supplies destined for food service to retail. March food service sales dropped 30% from February and were down 27% from the previous year. Food service sales decreased further in April on a full month of stay-at-home orders and were down nearly 50% from last year. Most restaurants remain closed for dine-in food service in May, but there is optimism for reopening as we move towards June, although most analysts expect a slow recovery in food service. According to Euromonitor, only about half of U.S. food service sales are dine-in sales, which is the lowest share compared to other top markets. The high frequency of drive-through, to-go, and delivery food in the U.S. helps support at least some continuation of business, especially for limited service restaurants. So we saw supply chain adjustments as consumers switched from food service to retail, and we also saw supply chain disruptions on the slaughter side. As you can see on the table, slaughter and production for both beef and pork were significantly higher from January to March compared to last year. In April, slaughter dropped significantly and reached its low point compared to last year at the end of the month. In May, we continued to see lower year-over-year slaughter levels, and you can see USDA's adjustments to its 2020 production forecast. Despite this sharp decrease in slaughter, the U.S. does not have a shortage on the live animal side. And that's why production was expected to be record large in 2020. The latest quarterly hogs and pigs report was from March, and the market hog inventory was a record 71.3 million head. And in May, the number of cattle on feed was only the lowest since 2017, and it was still above the 5-year average. The slowdown in slaughter led to an increase in weights for both hogs and cattle in May, and the buildup of slaughter-ready cattle on feedlots. These charts show the change compared to last year for cattle and hog slaughter each week so far this year. You will note the increases in the first quarter due to record large hog supplies and abundant cattle supplies. In April, slaughter began to slow compared to year-ago levels and reached its low point compared to last year during the last week of the month. For the last week of April, cattle and hog slaughter were each down 35% compared to last year. Slaughter levels have been recovering in May as plants have taken extensive measures to promote employee safety. As I mentioned earlier, President Trump signed an executive order to ensure meat plants would continue to operate to the greatest extent possible as they continue to follow guidelines from the CDC and OSHA. The CDC and OSHA issued those guidelines in late April, which were specifically created for the meat and poultry sector response to the COVID-19 pandemic. Plants have used these guidelines, and over the past month, they have re-engineered workplaces to enforce social distancing, provided personal protective equipment, and implemented health screenings. With the new social distancing measures at the plants, chain speeds have to run slower than normal to enable distancing on both the slaughter floor and in fabrication. Moving forward, the return to normal slaughter will depend on the percentage of the workforce that returns to plants and on the changes in plant productivity that have occurred due to the new virus control measures. Slaughter levels rebounded through May with these new measures in place, but challenges remain to getting U.S. meat packing plants back to full production, including childcare for employees now that schools and daycares are closed, and also transportation for employees that usually carpool. As I mentioned earlier, 2020 U.S. beef, pork, and poultry production all were expected to be record large. U.S. beef production was coming off a record year in 2019, and pork production has set new records each year since 2015. Poultry production was record large for the last 7 years. In May, USDA revised its production forecast lower for the major proteins in 2020, but is expecting a strong rebound and return to record levels in 2021. And some industry analysts have more optimistic production forecasts for 2020 than USDA. Beef and pork exports were on a record pace during the first quarter of this year. Beef and variety meat exports through March totaled 335,000 metric tons, up 9% from last year, with value of $2.1 billion, up 8%. Pork and variety meat exports totaled 838,000 metric tons, up 40% from last year, with value of $2.2 billion, up 52%. Even with record large production levels during the first quarter, the U.S. was exporting a larger share of both beef and pork production. Korea is the second largest destination for U.S. beef exports, and it is a top 5 market for U.S. pork exports. Growth in beef exports was widespread across most markets, but Japan and Korea saw the largest growth volume, while the massive growth in pork exports was mostly due to China. Exports held this rapid pace during the first quarter of the year, even with COVID-19 affecting top Asian markets. But exports likely slowed in April and May on lower slaughter and higher prices, and as COVID-19 led to stay-at-home orders and lockdowns in other areas of the world, thus slowing food service demand of importers. Let's take a closer look at the U.S. beef situation. Annual beef production has been increasing since 2016, and production reached a new record in 2019, exceeding the previous record set in 2002. USDA was forecasting 2020 production up 2% in March, but now is expecting production to decrease this year. The U.S. has abundant cattle supplies, and USDA is expecting placements of cattle on feed to be pushed from this spring to later in the year, thus resulting in a strong rebound in production in 2021, as those cattle are now expected to be slaughtered in 2021 instead of 2020. Other analysts are more optimistic on 2020 beef production, with LMIC forecasting steady production in 2020. USDA expects beef production to be down 17% in the second quarter of this year, while LMIC expects beef production to be down 13% for the second quarter of this year. This chart shows U.S. cattle slaughter. The official slaughter data lags by 2 weeks, but this chart includes preliminary estimates for the last 2 weeks of data. You can see the strong increase during the first quarter of the year, with slaughter starting to decrease the first week of March. Slaughter levels have been rebounding since early May, and last week, slaughter reached the highest level since the beginning of April and was down 14% from last year. The previous chart was showing total cattle slaughter, and this chart is only showing fed, heifer, and steer slaughter. This chart does not have the preliminary estimates included for the past 2 weeks of data, but you can see the same trends as total slaughter. Although fed slaughter was up 5% in the first quarter of this year, compared to the 6% increase for total slaughter. Fed beef production was up sharply during the first quarter of 2020, with an increase of 8% compared to last year. Fed beef production started to decrease in April as slaughter levels slowed, but fed beef production began to rebound in May. In addition to the strong increase in total fed beef production, prime and choice grading percentages have been at record highs all year, meaning the quality of beef the U.S. is producing is at a new high. Beef quality has been increasing in recent years because of improved genetics and feed management. Year-to-date, 10% of total fed beef production graded prime, while over 73% graded choice. The prime beef grading percentage reached a weekly record of nearly 12% in the latest week of data. U.S. prime beef production dropped below year-ago levels in mid-April, and prime ribeye wholesale prices increased from mid-April to mid-May. In mid-May, prices were up 44% from the same week last year, but remained below the record levels from last September. Marketings of fed cattle were very strong and were above year-ago levels from January through March 2020, which kept the inventory of cattle on feed current. However, in April, the limited slaughter capacity pressured cattle prices lower and deterred placements of cattle on feed. That trend continued in May, with those cattle expected to be placed on feed later in this year. The decrease in placements in April and May led to lower total numbers of cattle on feed. But although the inventory of cattle on feed was down from the 2018 and 2019 highs, the inventory was otherwise the highest since 2011. Marketings of fed cattle dropped in April because of limited slaughter capacity that month. Because of the slower marketings, more slaughter-ready cattle remained at the feedlots that would have normally been sent to slaughter. This led to a buildup of cattle on feed over 120 and 150 days, both of which were the highest since 2012, and again indicating that there is no shortage in the U.S. on the live animal side. The futures market is indicating that the worst is perhaps behind us, with the futures trading higher in May on rebounding slaughter levels. Cattle prices decrease when more slaughter-ready cattle are available than slaughter capacity, and we saw a similar trend last fall after the plant fire. So although cattle prices are pressured by the decrease in slaughter, beef prices surge because of the lower production. On the chart, you will see the increase in cattle prices in mid-May when packers paid more for fed cattle because of the spread between cattle prices and boxed beef prices. Futures are still trading below recent year levels for the rest of the year, as it will take time to work through the buildup of cattle, and as food service demand is not expected to immediately recover. The choice beef cutout saw an initial bump in early March as consumers stocked up at retail, but then it trended lower on the lack of food service demand. In the second half of April and the first half of May, the cutout surged to unprecedented levels, by far surpassing previous highs, and doubling in just 4 weeks to $4.60 per pound in mid-May. Last week, the cutout started to ease as production and slaughter continued to rebound, dropping 12% from the previous week to $4.05 per pound. The price trends differ by primal. The round and chuck cuts surged for 2 reasons. The first is that these items are popular domestic retail items, with roasts featured as easy dinners for families. The second is that these products were needed to grind with fat trim to make ground beef. I will talk about ground beef more shortly, but it is the top beef volume item at both food service and retail in the U.S. Quick service restaurants tend to use imported lean trim and domestic fat trim to make ground beef for their burgers. But ground beef sold at retail more often uses chuck and round cuts to blend with fat trim. So in April, we saw the surge in prices just for rounds and chucks on strong retail demand, while values for the other primals decreased due to the drop in food service demand. But all primal values surged in May because of the lower slaughter and production. Last week, primal values for all choice primals declined, but ribs and loins declined the least week over week. Ribs and loins see seasonal increases in the summer for the grilling season, which usually kicks off with the Memorial Day holiday that was yesterday, May 25th, in the U.S. Additionally, as restaurants plan to reopen, they are securing rib and loin supplies as well. Let's talk about the details on food service and retail splits by cut a little bit more. Domestically, more beef is used in food service than in retail, with a roughly 60 to 40% split. In 2018, limited service restaurants accounted for 45% of the beef volume sold at retail, followed by full service restaurants at 24%. With the extreme popularity of burgers in the U.S., ground beef accounts for the majority of beef volume sold at food service, accounting for 64% of all beef volume at food service in 2018. Pre-cut steaks and roasts are the next largest category of beef sold by volume at food service. For pre-cut steaks, top items include sirloins, fillets, ribeyes, flanks, skirts, strip loins, top loins, and flat irons. For roasts, tenderloins, prime rib, round roast, chuck roast, and briskets are the top volume items at food service. Ground beef is also the top beef volume item at retail, accounting for half of all beef sold. Other popular retail items include various steak and roast cuts, like ribeyes, strip loins, chuck roasts, T-bone steaks, top rounds, and sirloins. So even though ground beef is popular at food service, takeaway business is still continuing with quick service drive-thrus. And ground beef is the top beef item at retail and has continued to see strong sales since March as a tasty, easy, familiar, and versatile ingredient for consumers who now need to make more meals at home. This ground beef demand has been a major factor driving chuck and round prices to new records earlier this month. And you can see on the charts below that wholesale ground beef prices reached a new record in May as well, with April retail data showing ground beef prices at retail at the highest level since 2015. Now, let's discuss more about the U.S. pork situation. U.S. pork production was expected to set a new record for the sixth consecutive year in 2020, but in May, USDA revised down its forecast. USDA had been expecting production to be up about 5% and is now expecting a slight decrease in 2020 before returning to record levels in 2021. Other industry analysts are still expecting growth in the production year, with LMIC forecasting a 3% increase in production in 2020. This chart shows the official U.S. pork production data, and the data is lagged by 2 weeks. For January to March, pork production was up 9% from last year, before production moved lower in April. Production started to rebound during the first week of May. This chart shows U.S. hog slaughter, and it has the preliminary estimates from USDA AMS included for the 2 most recent weeks of data. Hog slaughter was also up significantly during the first quarter of the year, up 8% from last year. After reaching its low point compared to last year at the end of April, slaughter levels have been recovering in May, and last week's slaughter was down just 8% from last year, as compared to the 35% decrease compared to last year 4 weeks ago. Iowa State University provides estimates on market hog profits with positive returns last year from March to August, with the lifting of Mexico's retaliatory tariffs on U.S. pork and exports beginning to boom last summer. This year, returns were negative in April because of the lack of available capacity at plants. Even though there were record large hog supplies, labor availability at the plants due to COVID-19 led to the lower slaughter levels, which pressured hog prices. However, the futures market is indicating that the worst of this situation may be behind us, as slaughter levels have continued to rebound more quickly than most expected in May. After moving sharply lower from COVID-19 disruptions initially in March, hog prices have been rallying since late April. Earlier this year, hog futures had been expecting hog prices to be similar to year-ago levels, with record large exports supporting prices. Now the market is factoring in slower food service demand and potential continued disruptions from COVID-19 at plants. Like beef prices, wholesale pork prices increased in early March because of panic buying, but then prices trended lower later in the month on the drop in food service demand. The pork cutout then surged later in April and in the first half of May because of the lower production levels. Last week, the cutout declined for the first time in 6 weeks as production continued to rebound, at $1 per pound, which was down 13% from the previous week. The current price peak of $1.15 per pound in mid-May remains below the record highs from 2014, when annual pork production decreased by 1.5% due to PEDV. The red bar on the chart shows the average wholesale price for each pork primal in April, and the loin primal was the only primal with higher values in April of this year compared to earlier in the year and compared to April last year. This is because loin prices surged on strong retail demand, while other primals saw lower values because of the drop in food service demand. In the first half of May, all primals moved higher with the lower production levels, but last week, popular retail items, including loins, ribs, and buds, continued to increase, while the belly primal saw a sharp drop in values due to continued slower food service demand. Slightly more than half of pork is sold at food service in the U.S., and nearly 80% of pork sold at food service is processed pork. Limited service restaurants are the main food service users of pork, and they feature items like bacon and sausage breakfast sandwiches. Bacon alone accounts for 1/3 of the total volume of pork sold at food service, followed by breakfast sausage, ham, ribs, and shoulders. At retail, on the other hand, 40% of pork volume sold is fresh pork. Out of the fresh pork total, pork chops alone account for 36% of total fresh pork, with the top volume cut being center cut chops. Ribs also account for a large share of fresh pork sales at retail, with spare ribs and back ribs as the top items. After pork chops and ribs, roasts, boneless loins, and shoulders are the other top fresh pork items at retail. After fresh pork, sausage is the next largest category with 19% of pork retail sales volume, followed by bacon with 16% of volume sales and ham with 10% of volume sales. Pork in cold storage built up in the second half of 2019 and in early 2020 because of record large export volumes. Pork stocks had a sharper than usual drawdown in March as buying at retail surged, but pork belly stocks have continued to build up in March and April, reflective of the slowdown in food service demand. In conclusion, although U.S. beef and pork production decreased sharply in April due to lower slaughter, production has been rebounding in May, and wholesale prices began to ease at the end of the month, although they continue to be supported by very strong domestic retail demand. The U.S. was expected to have record large production for all of the major proteins this year, but COVID-19 related disruptions could lead to lower production levels. However, cattle and hog supplies remain abundant in the U.S., and as slaughter levels continue to rebound, the dynamics driving record large exports earlier in the year should continue, and there may be new opportunities for items traditionally destined for U.S. food service. Thank you.